Pause for a second and think about this. According to official reports from the Investment Company Institute, over $37 trillion sits in United States retirement accounts alone. IRAs, 401ks, pensions. Yet most people have no idea that, in a true financial crisis, those assets could be locked or even seized in less than 24 hours. That's right. Decades of your hard-earned investments, not technically yours at all, if the legal fine print is activated. You might think, I've diversified, I'm safe. But what if the number one mistake isn't your portfolio mix, but believing those accounts are actually under your control? Today, I'll show you the hidden legal structure that makes this possible. Reveal a real-world case where everyday people lost access to their savings. And, most importantly, give you 3 proven steps to bulletproof your right assets, starting this week. Ready to audit your financial reality? Let's break open the secrets of the great taking. One of the things I absolutely love about running Ray Invests is the constant flood of emails and comments where you, my community, tell me exactly what's keeping you up at night when it comes to money. And lately, there's been a tidal wave of questions about something called the great taking. When I was younger, dozens of you have sent book recommendations, video links, and pointed questions. And if you've never heard of this before, gather close, because it might just change the way you look at your portfolio, your bank, and your entire financial setup. The heart of the great taking is a claim by David Webb, an industry heavyweight who spent his career on Wall Street, managing billions, working with premier hedge funds, banks, and even government officials. His message is simple but chilling. Through a long series of subtle legal and technical changes, most Americans, and honestly, most investors worldwide, have quietly lost direct legal ownership of their financial assets. Let's set the stage with a hard fact most people don't know. According to DTCC filings and the Investment Company Institute, as of 2024, roughly $37 trillion in United States retirement and brokerage assets are not held in your name at all, but in street name by custodians like the Depository Trust and Clearing Corporation. When you open a brokerage, retirement, or even a simple banking account, you sign agreements, hidden pages of fine print, drawn up by teams of lawyers working for the big institutions that give those entities extraordinary power over your assets. It's not conspiracy. It's right there in black and white. For example, that Uniform Commercial Code, or UCC. It's been revised, and in many United States and numerous countries around the world, it spells out exactly how custodians can freeze, reallocate, or convert your assets in a so-called systemic emergency. All with just the push of a button. Now, this isn't a hypothetical, it's codified law. First major progress marker. Let's break down what you actually own. When you see stocks, bonds, or even mutual funds in your online statement, you don't technically own the asset. You have what's called a security entitlement, which means you're entitled to the financial value, but not the asset itself in a crisis. Here's a direct quote from DTCC documentation. Participants are credited with securities, but legal title is held by the nominee. Translation: if the system needs to shore up liquidity or avert a collapse, it can legally freeze, reallocate, or even convert the value in your account without it being considered theft. You agreed to this when you clicked I agree. Understand, this isn't just about crashing markets or wild speculation. The real-world mechanism is already built inside the digital infrastructure you rely on for daily banking and investing. The excuse for these extreme measures is to keep the system alive in case of major volatility, fraud, or a rung on financial intermediaries, giving them the legal right to pull assets into a collective pool and effectively bail in the institution instead of bailing out with government money. Now, let's throw in a micro CTA here for everyone watching. Pause and check your last brokerage statement, or think about your main investment account. Have you ever actually reviewed who holds title to your securities or deposits? Comment ownership if you've looked into this, or just type Surprised if this is news to you? Let's get honest in the comments. This is how we all learn together. Here's where the rubber meets the road. All of this sounds theoretical, but there's precedent. And I want to walk you through exactly what happens in a crisis. Imagine an average Thursday morning on Wall Street. Markets open. All seems routine. But inside the nerve center at DTCC, or a major clearinghouse, a sophisticated algorithm flags sudden liquidity. Stress. A major counterparty starts running low on cash. In milliseconds, an emergency protocol kicks in. Olio, the much-discussed emergency continuity procedures. These are proprietary, hidden within the architecture of modern financial software, according to former industry insiders like David Webb. No flashy headlines, no public statement. Instead, key money market funds freeze withdrawals out of an abundance of caution. Financial media downplay it as minor turbulence. But on the inside, the system is entering total lockdown to contain risk. Within hours, customers like you check their banking or brokerage app, only to find their balances temporarily unavailable. ATMs might not dispense cash. Wire transfers are delayed. Customer service says scheduled maintenance. And before 24 hours have passed, nearly every account is facing some restriction. This isn't a movie script. It's what real-world playbooks and past crises have primed the system to do. Pattern break. Let's look at a real historical case, not just theory. In 2013, Cyprus, an EU member state, experienced a full-scale banking crisis. The government declared a bank holiday. Every single bank shuttered its doors. Within an hour, every citizen found their accounts frozen, unable to withdraw cash. Authorities then imposed a one-time bail-in levy, 6.75% on deposits, up to 100,000 euros, and 9.9% above that. Yes. Nearly 10% of large depositors' money gone overnight, legally executed to recapitalize failing banks. It didn't matter if you were a retiree, a small business, or a savvy investor. Everyone faced the same reality because every account was electronically pooled and seized for the collective good. According to the European Central Bank, and reports from Reuters 2013, customers lost direct access for days, and some lost a large portion of their savings permanently. The principle, not just possible, it's happened. Now back to the United States and major economies. The exact structure is different, but the mechanisms and legal codes exist from the Dodd-Frank Act of 2010, Title II, Orderly Liquidation Authority, to SEC rules, to the revised UCC. First curiosity loop here. Does the same risk extend to major American or Canadian banks? I'll show you the details and surprising real-world headlines in just a minute, including a recent Canadian bank freeze that caught thousands off guard. Back to our scenario. Officials step in and announce a stabilization window with the Federal Reserve or other authority, hosting an emergency press conference. Your money is safe. The system will be back to normal soon. But behind the scenes, assets previously held in your name are now considered collective collateral. In the name of system stability, your money is absorbed by institutions to prevent a total collapse. Progress marker. Let's bust the 3 biggest mistakes I see around asset custody, each one with a practical fix you can apply. This week. Mistake number 1. Believing account statements mean true ownership. Most people trust the names and numbers on their statements. But, as we've detailed, the title, the legal claim, is held by custodians. If you don't control it, you don't really own it. Ask anyone who's been through a bank freeze. This isn't just my saying. It's a lesson from headline news. Solution. Establish direct legal ownership where possible. For stocks and securities, this means considering direct registration with the issuing company via DRS systems where available. Some of the biggest firms allow this. For example, DTC's direct registration system. No. for IRAs or 401ks. Look into self-directed accounts with checkbook control, where you can directly title certain assets. For physical assets, take ownership. Think physical gold, silver, land that has your name on a paper deed, not a digital line item. Mistake number 2. Over-concentration in a single jurisdiction or asset type. Many investors leave all their wealth inside one country, one bank, or just a few asset classes, thinking that's safe. But Cyprus, Canada, 2022, and even American examples after the 2008 crisis show that regulatory moves can sweep through a whole sector. Solution: diversified jurisdictionally and in asset form. This isn't just about spreading between banks, but between legal zones and asset types, too. Physical precious metals in a safe you control, and in some cases overseas. Some real estate in your direct name, some cash on hand, plus digital assets only in accounts with clear segregation of client funds. If you're above the FDIC or SIPC insurance limit, that's $250,000 per bank for FDIC, $500,000 per broker for SIPC as of 2024. Consider splitting assets or seeking alternative custodians with strong client protection histories. Mistake number 3. Ignoring conditional access and emergency provisions. Most people have never read their brokerage agreement or banking contract. Under UCC revisions and Dodd-Frank Title II, major custodians can suspend, reallocate, or subordinate your entitlement if a systemic risk is declared by regulators, not just theoretical. This playbook appeared in 2008-2009. Financial crisis and bank resolutions have trended toward more bail-in features globally since. Solution: audit all your agreements and set triggers in advance. Go back and review the account agreements for your major accounts. Look for terms like securities entitlement, force majeure, resolution authority, and emergency reclassification. If your brokerage or bank won't provide a clear, plain English answer on what happens in a systemic event, that's a red flag. Consider opening secondary accounts at client-focused institutions, or, if available, credit union, which in some countries have a different risk profile than large banks. Pattern break. Let's take these steps from theory to tools. To make this easy, I've put together a free personal asset custody checklist, a step-by-step self-audit you can use to spot weak points and actionable next steps in your own financial setup. The link's below this video, or just screenshot the summary you'll see on screen in a moment. And here's a micro CTA. Download that checklist and let me know in the comments if, as you walk through it, you find a blind spot in your own asset safety net. Real progress happens when you take 5 minutes to close those gaps. Now, second curiosity loop. Know as you're under. Did this situation hit closer to home than you think? In 2022, many Canadians were shocked when protest-related account freezes swept through the country. Major banks, at the government's request, legally seized or froze access to hundreds of accounts flagged as high risk, with little warning and no due process for most. According to CBC, thousands of mainstream customers lost access to funds for days, some for weeks, even if you weren't involved in protests. Simply being in the wrong place at the wrong time. Time was enough. If it could happen in one G7 economy, it can happen in others. Progress marker. Let's move from education to action. Here's your 3-part asset protection action plan. These are simple moves, not just theory. First, inventory every single asset you hold. Bank, brokerage, crypto, precious metals, real estate. And write down not just the dollar value, but who the legal owner is on paper if it isn't your name. Find out exactly whose it is and what agreement governs what happens in a crisis. Second, Move at least 10 to 20% of your net worth outside the digital-only system if possible. This could mean physical cash within safety and insurance limits. Select precious metals or property titled to you. If you're already 100% digital, target at least one physical asset this year as your first step. Third, diversify your risk. Even in the digital world, this means splitting assets across several banks, staying under FDIC, SIPC, or NCUA limits, using both brokerage and credit union setups, and, for more advanced investors, holding certain assets with international or multi-jurisdictional custodians. After careful professional review, need to see how others structure their coverage. You can download that free checklist, link again below, and benchmark where you stand. If you're feeling overwhelmed, remember, it's all about small steps and ongoing awareness. Pattern break. Let's visualize this. Imagine 3 circles. Legal title, direct, jurisdiction, multiple locations and asset types. His adventure and access, redundant backups like cash and physical asset. Keys. Your goal is to have at least one asset safely inside each circle, so no one system failure wipes you out. It's not just how much you have, it's how you hold it that matters. Now, here's a quotable idea to share. Wealth, safety is structure, not size. And for anyone worrying, here's a quick risk caveat. FDIC and SIPC insurance really does protect most Americans up to those limits. And no United States regulator is incentivized to create a full-scale seizure. But as the 2008 and 23 banking crises showed, there can be delays, partial holds, or sudden freezes even with every safety net in place. Stay alert, not anxious. This is about resilience, not paranoia. Micro C T A. Would your current bank or broker survive a waiting systemic freeze? If you're not sure, comment your greatest worry below, and let's crowdsource some real-life solutions as a community. As we wrap this up, a few legal and financial realities. Look, none of this is meant to stoke fear or desperation. These are practical steps, and all educational. According to the BIS, over 100 central banks globally are piloting or studying central bank digital currency, and the United States Uniform Commercial Code has rolled out digital asset control amendments across dozens of states. The backbone for systemic asset management is strengthening every year. The DTCC alone now sits as custodian on nearly all United States stocks and corporate bonds. Since 2008, reforms have actually increased the industry's resolution authority, giving custodians, central banks, and clearinghouses the power to freeze or reorganize assets as collateral in a systemic event. That's why the educated move is to maximize your exposure to direct legal ownership, and don't treat digital access as the same thing as true control. If all this feels like too much, just start with that inventory. Check your account agreements and download the personal asset custody checklist below. I promise you'll sleep better at night when your financial life is anti-fragile by design. It's about independence, not isolation. It's about options, not fear. Remember, while I'm sharing what I've learned through years of research, conversations with Wall Street insiders, and analysis of real-world crises, this is for educational purposes only, not financial advice. Everyone's situation is different, and systemic risk can change fast. Before making any major changes, consult a certified financial advisor or legal professional, especially for cross-jurisdictional moves or advanced asset custody. Are you surprised by how little you truly own under the current system? Let's start a real conversation. Share in the comments. What surprised you, scared you, or motivated you most today? And if you want to go deeper, check out the checklist and resource links below and join our financial self-defense community here at Ray Invests, where we get stronger together. Here's the quick recap. The assets in your brokerage, retirement, and bank accounts, potentially totaling $37 trillion nationally, are technically not fully under your personal control, due to legal structures few people ever read, as the Cyprus bail-in and Canadian account freezes show. This isn't just theory. Asset access can be cut off or reclassified overnight. That's why today I broke down the 3 biggest mistakes: believing statements mean ownership over concentration in one jurisdiction, and ignoring emergency fine print, and the practical solutions: direct legal title where possible, jurisdictional and asset diversification, and actively reading your agreements. If you do one thing this week, download and complete the free personal asset custody checklist, linked below or shown on screen. It'll walk you through every step to audit and strengthen your setup. Set short-term goals. Inventory all assets this week. Move one account to a safer structure in 30 days. Review your risk yearly. With this approach, you'll maximize resilience over 6 to 12 months. Not just for doomsday, but for any market stress. You may not feel results overnight, but by next quarter, your anti-fragile framework can already be in place. Don't forget, download the checklist. Let us know in the comments what shocked you most, and share your asset safety blind spot so others can learn and not repeat your mistake. If you found value in this, subscribe to Ray Invests and turn on notifications. Next up, I'll reveal my personal asset safety routines, plus real stories from viewers who've survived it. Brokerage freeze. Your comments could help shape that episode, so ask your biggest wealth safety question below. Not financial advice. This channel is for education and awareness only. For major asset moves, talk to a qualified advisor or legal expert before making changes. Stay curious and stay in control.